Hi and welcome to Swissquote's Daily Market Talk. It's Wednesday, March 26th. Global financial markets seek direction before April 2nd, the Liberation Day, when the US is due to unveil reciprocal tariffs that it will apply to its trade partners. Meanwhile, sentiment surveys on two sides of the Atlantic Ocean tell two different stories, and even sentiment on two sides of the channel tell two different stories. So the latest data from the Conference Board in the US came to back the mounting concerns among Americans regarding the future of their economy and inflation in the US that the set of Michigan numbers have already warned about. So the consumer confidence in the US and in this particular set of data plunged to a 4-year low, and inflation expectations jumped, and they jumped on tariff uncertainty, unsurprisingly. Now, remember, according to Jerome Powell, the Fed president, the US data remains strong, but the latest growth forecasts have been souring at a very scary speed, and the rising worries among people and consumers and the rising inflation expectations tend to be self-fulfilling, and the impact of sentiment on what we call hard data, so data like growth, employment, and inflation, should be closely monitored. Now, interestingly or not, the German data tells the exact opposite. Business optimism in Germany hit the highest level since last summer, as the massive government spending that the German government is about to unlock brings hope in the whole continent across the German and also the French manufacturers. So the convergence that we see in sentiment between the two continents, between the US and Europe, continues to develop and be confirmed by the data, and the latter backs the rotation trade still. As such, the Stoxx 600 index rebounded at yesterday's trading session after a 3-session correction, while the US equities on the other side of the Atlantic Ocean traded with no clear direction really after a strong Monday rebound. So the S&P 500 closed yesterday's trading session very close to where it started the day. The doji candle formation here typically hints at uncertainty and hesitation among investors about where the US valuations should be headed next. As I mentioned at yesterday's episode, analysts from big US banks now think that the worst of the US market sell-off is probably behind us, while analysts in the European banks, including myself, actually have been warning that there could be a bit more pain for the US equities on the pipeline before a certain relief. And in fact, everybody is now looking at April 2nd, hoping that the tariff situation will see some clarity with the US unveiling its reciprocal tariffs. But it's possible that April 2nd just becomes another day of imposing and pulling back tariffs in the continuation of a hectic and an unpredictable trade policy that the White House has been following since the start of this year, since Donald Trump took office in January. As such, the price rebounds that we might see in US equities do give relief to investors, but they do not guarantee the worst is over. Price volatility and pullbacks, on the other hand, offer very interesting trading opportunities to investors who obviously love volatility and have been somehow chasing corrections and dips to enter or to strengthen their positions in US equities. But valuation-wise, the rebound that we saw in the European stocks so far this year sure narrowed the valuation gap between the US and the European counterparts, but the Stoxx 600 prints a PE ratio of around 17 today versus the S&P 500 that still prints a PE ratio of near 29. So the question is whether we will see a further convergence between the two. The answer is, it depends. I'm sorry, I cannot give a clear answer to that. One of the major boosters of sentiment for the European equities this year has been this decision from the European governments, and especially from Germany, to unlock massive spending on infrastructure and security. We talk about it every day. And the latter weighed heavier than the tariff fears for the European stocks and boosted growth expectations. So that spending narrative is still in play, but it is now widely priced in. Therefore, all the European stock investors will probably be facing the tough reality of the tariff gain in the coming weeks of trading, and the latter could eventually slow the rally that we saw in the European equities so far this year, and also the appreciation of the euro, but it may not reverse it. Now, the euro dollar is consolidating gains below the 108 level this morning. At the time I'm talking here, minor support is seen between 107.30, 107.80 area, including the minor 23.6% Fibonacci retracement on the year-to-date rebound and the 200-day moving average, while a major support to this bullish trend stands near the 106.75 level, the major 38.2% retracement that will distinguish between the actual bullish trend in the euro dollar and a medium-term bearish reversal. Remember, many banks have been predicting that the euro would hit parity against the US dollar due to tariffs, but the euro took the opposite direction instead since the start of this year, hinting that the Europeans do have the power to reverse the tables, but what Europe really needs right now is to turn this infrastructure and security spending into real growth, while the US growth is slowing. So in summary, the rotation trade is probably not over just yet, but it could be somehow shaken by a new tariff wave in the short run. Now, across the channel, the tariff fears are amplified by the fact that the United Kingdom won't benefit from the ample budget spending that the continental European peers like Germany and France will. On the contrary, the spending hopes for the British government have been crumbling as borrowing costs for the UK keep rising and the latter decreases Rachel Reeves' fiscal headroom. The impact of tax rises, on the other hand, hit appetite and growth in the UK, and the Bank of England is not in a hurry to provide relief to the UK economy with interest rate cuts pointing at global and trade uncertainties of the moment. So, released this morning, just freshly this morning, inflation in the UK came in softer than expected, providing a minor relief to the market before today's budget announcement. But we already know that Rachel Reeves will be announcing a smaller spending envelope later today. She is expected to announce a £10 billion worth of cut in a day-to-day government spending, and the smaller the size of the envelope, the bigger the impact on sterling. In the international waters, news of a partial truce between Ukraine and Russia in the Black Sea region saw a limited reaction from oil traders yesterday. In theory, a truce or a partial truce should ease sanctions on Russian oil exports and should have an easing effect on oil prices. But oil prices are relatively steady since yesterday, and US crude continues to test the $70 per barrel psychological resistance, hinting that the market oil traders are not buying the Russian truce news for now. But the rising hope of a potential truce is a downside risk for oil prices in the short run, and the latter could temper appetite from oil bulls, along with the supply and demand gap of the moment still pointing at cheaper oil in the medium term. Copper futures, on the other hand, on Comex advanced to an all-time high level at yesterday's trading session as buyers in the US rushed to buy copper before tariffs hit, and that's pushing the prices higher, increasing the gap with copper prices elsewhere. But because copper is known as a barometer of global growth, and the latter, the global growth expectations, are being pressured by an escalating trade war, it is, in my opinion, just a matter of time before we see a sizable correction in copper prices on Comex. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope This episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, and also on our new WhatsApp channel, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.